Hi everyone, it's Saturday and my baby's having her lunchtime nap, so I'm going to use this opportunity to go over what's been happening with the stock GameStop this week. I got so many questions on my Instagram from people who don't necessarily follow financial news or markets or watch CNBC, even though of course you should be watching CNBC, asking me to explain in simple terms what has happened and why Wall Street is up in arms about this one particular stock and how this has become such a big deal. So I'm going to try my best to explain it in a couple of minutes time, even though it is actually quite a complicated story if you look at all of the different players involved. The main thing I want to say is that what happened to GameStop this week is nothing to do with the company itself. It's not like the company came out with some massive announcement and investors took a view based on that announcement. What happened to GameStop was a function of what the investment community decided to do with it. So you have to distinguish between the two. This isn't based on some fundamental analysis. This was basically the modern day equivalent of financial gambling going on. So let me explain the different players. GameStop is just a normal retailer that deals with video game merchandising. They buy and sell old video games, consoles, things like that, and they exist primarily in the store format. So you can imagine, due to the changing nature of how people play video games, that their business model was coming under pressure. If people are playing video games online, then obviously a retailer that sells them in real life is going to come under some selling pressure. The second is the pandemic hit in 2020. People stopped going to malls, stopped going to stores. So any store, and this isn't specific to a video merchandiser, any single store out there, retail, non-essential, got hit as well. So GameStop stock started coming under pressure and sold off throughout the course of 2020. But that only got exacerbated when a group of hedge funds decided to come in and take a view that the price of GameStop would go even lower than where it was currently trading. And so these hedge funds initiated what is known as a short position. They decided to borrow the stock in the market, hoping that they could buy back the stock at a much lower price at some point in the future, because they believed that the price of the stock was going to continue to go down. So let's give it simple math terms. If GameStop was trading at $10, they shorted at $10, borrowed that stock, hoping that it would go down to, let's say, $5 or $3, whatever it is, so they could buy it back there and book in the $5 or the $7 profit that they would have made being short that stock. Now, because of the nature of financial markets, what happened is the size of the short on that stock got to extreme levels. So hedge funds were not only shorting by borrowing the stock, they were also shorting by buying options. So they would buy a put, which is essentially an option that allows them to sell at a certain price in the future if the price of the stock continues to fall. So let me just re-explain that. I didn't explain that very well. So if the current price of the stock is $10 and they buy a put at $7, if the stock then drops to $5, they can exercise the option to sell at $7 and book in a $2 profit. So they were not only taking a linear position, but they were also taking a position via options. And that was one of the reasons why the size of the outstanding short on GameStop was so extreme. Now, on the other side, you had a bunch of retail investors who were looking at this and said, hang on a second, how come the size of the short is so large? And why is the hedge fund community betting so big on this one particular stock? Not just GameStop, by the way, a whole bunch of other stocks out there as well. We'll get to that in a second. So one influential figure in the retail community said, all right, well, I'm going to take the opposing view to that and I'm going to buy calls. So the same way we talked about the option to sell, the retail community, this one particular guy, took the option to buy the stock at a much higher price in the future. Then he went to this Reddit forum and he explained his investing thesis to this big farm community of retail investors. They talk about their stock tips all the time. This was his stock tip. And what happened is it created a bit of a buzz. So the next thing we knew, there were a whole bunch of other retail investors getting involved in the trade as well. And when they caught wind that there were hedge funds running substantial shorts in the stock, the thesis moved from let's just buy GameStop to book a quick profit to let's buy GameStop to put these hedge funds out of commission. And then what happened was a parabolic rise in the stock price of GameStop. So the way that worked is, let's go back to initial hedge funds. So if you were the hedge fund who shorted at $10 and then all of a sudden your stock went to $15, $20, $25, $30, $40, kept going higher. It doesn't mean that you were not impacted, because at the end of the day, you had to borrow that stock in the market. So the more the price moved against you, the more the person you borrowed it from said, well, look, you need to give me margin. I need to make sure that if you do ever stop out of this trade, you have enough money to cover it. So the hedge funds themselves who had borrowed the stock started receiving these margin calls from all of their counterparties, from the prime brokers that they would have borrowed that stock from. And as the stock continued to move against them, those margin calls got more and more substantial in size. Equally, on the other side, you had all of these retail investors who were buying the stock like there was no tomorrow, in both stock form and cash form, but also in option form as well. So if you were a bank like Goldman Sachs or Citi or whichever a bank that would sell those options or underwrite those options to the retail investor community, all of a sudden you were faced with the prospect of delivering on an option that was miles away from where you thought the stock could get to. So if a retail investor came to you and said, look, I want to buy a call option to buy GameStop at $100, you probably would have priced that option pretty cheap when the stock was trading at $10. But then all of a sudden, the stock price started rising extremely quickly. Once you got to $80, $90, the person who sold it, so the bank that sold it to the retail investor, was in a bit of trouble, because then they might have had to deliver that stock. And so it exacerbated the move. So then all of those dealers had to start buying up the stock as well. So that's the second reason why we saw big momentum. And then the third is other people like hedge funds, CTA-driven hedge funds, momentum-driven hedge funds, then saw the stock rising super rapidly. And they thought, well, we want in on this. Clearly there's momentum in the trade. Let's get involved too. So what happened was a meteoric rise in the price of GameStop. It got as high as, I think, $400 at some point. So it started the year off at around $15, got up to $400 in the space of a couple of weeks. And one of the high-profile hedge funds that was running a short in that stock had to get out. They were bailed. They received a bailout by a couple of other high-profile hedge funds as well, but that wasn't enough to contain the losses that they had sustained on that one particular stock. So the takeaway from the retail investor community then was, well, look, we managed to we won this battle against one very high profile hedge fund. What are other stocks that we can look at as well so we can replicate this thing? So then they started going through a whole bunch of disclosures that hedge funds have to give on a regular basis if they've built a substantial position in a particular stock. And they started piling into other names. So some of the other names, for example, were AMC Entertainment, that is literally a company that runs movie theaters that's been closed for the better part of the year because of the pandemic. That stock too, its stock price increased by something like 300-400% over the last couple of days. There was another case of an energy company in Texas with only 5 employees that hasn't released any financial statements since last August, that skyrocketed 1,000 percentage points on Thursday alone this week. So the takeaway from all of this is that all of a sudden the retail community got very powerful and very astute at piling into the stocks that the hedge fund community had shorted. And this was the big battle that got played out. Now, there's an additional dynamic that also you may have read about, which was that at some point in the middle of last week, one of the very popular retail trading apps, an app called Robinhood, decided for one day, it turned out it was going to be a temporary ban, but for one day to stop the retail community from buying the GameStop stock. So this was a big deal. Because it meant that the main method for the retail community to continue buying into these particular stocks that they had focused on had been closed to them. The door was closed. And the rationale from Robinhood, the trading platform, was that because the volatility of the stock had increased so much, and because they had so many outstanding positions on GameStop, they needed a bit of time to plug in the capital that was required to continue servicing those trades. But the takeaway from the investor community was, hang on a second, why is retail being punished? And why can they not continue to buy into the stock while the institutions and the hedge funds can sell the stock? So this was one of the other big stories that was going on last week as well, and that the retail investing community felt extremely aggrieved by this decision from Robinhood to cease trading for a short amount of time. They say it was because of capital and liquidity requirements. So that's one of the other big questions that's come up. So there are two big themes I would say as a takeaway from what happened last week. The first is that the retail community, so the average individual investor, is getting increasingly mobilized and increasingly more aware of how to play in financial markets, and they are leaving their footprint to the extent that they actually forced a hedge fund to close out of its positions and crystallize a substantial loss on their books. The second thing is that there's a lot of work to be done on the regulator side. The fact that this actually happened raises a lot of questions. There are two angles to it. The first is whether the discussion board on Reddit is market manipulation or not, and that is a big question mark, because if you read the language around market manipulation, it is a bit fuzzy, and there's a lot of room for interpretation. Essentially, it would be construed as market manipulation if it were a pump and dump scheme. So if all of the people who were talking about buying GameStop had the express desire to then quickly dump the stock into the buying. Difficult to prove, especially because it was done in an open forum. So what is the difference between 3 million individual retail investors having a chat on a forum versus a hedge fund coming, say, on CNBC and saying, I don't like this stock because of XYZ? That's why there's a lot of obscurity in the topic. The second thing is Robinhood's decision to close up the platform. Again, it's coming under regulatory pressure, and this was one of the few times we've seen both the left and the right in the US and politics agree on something. So AOC and Ted Cruz both put up tweets saying we need to have a further investigation into Robinhood's decision to close up the platform on those particular trading stocks, because it shouldn't be allowed that retail investors get locked out of investing or trading a stock that they have expressed interest in trading in. So those are the two angles. Very, very interesting story. It's created a lot of volatility in the markets, created a lot of discussion, but I think it does raise a really important theme, which is that the financial markets have traditionally been the domain of the big institutions, but now what we're beginning to see, at least in the US, is the retail investor base has become so much more animated, so much more alert, and has access to platforms like Robinhood that have really facilitated them to have a massive footprint on the way we trade. So it's definitely going to be one of the big stories for the future. How this is all going to end, I don't know. Should GameStop be trading at $250? No. But I'm going to end with what I started with, and that the whole premise of this was not because investors thought that GameStop was such an amazing buy. It was purely a ploy to inflict as much pain as possible on the hedge fund community that had massively leveraged short positions on one particular stock. It could have happened to any other stock. But yeah, so that's a little bit about what happened. I think I've gone on for like 15 minutes. This was supposed to be a 3-minute video. If you have more questions, let me know.